This is an exclusive presentation of KSL News Radio. Our banks, our savings.
2 different regional banks have shut down.
Top executives are now facing a class action lawsuit.
Any failure is their problem, not your problem.
What is happening to the banking system this week? Why wasn't it caught? And how safe is our savings really? Here are Dave Noriega and Debbie Dujanovic.
It was 1 week ago. The wheels were falling off Silicon Valley Bank. And by Friday, it had crashed and burned. It was shut down, and people were lined up trying to get billions of dollars in deposits back. And by the weekend, Signature Bank in New York had fallen. And many worried what this week would bring for other banks. So we are committed to extending our in-depth coverage. We have already gone so in-depth this week, giving you great tips, action steps to take, information, knowledge we didn't have before these bank collapses. We're going to continue our commitment to giving you more information for the next 2 hours.
I've learned more about private banking, commercial banking, investment banking in the last 4 days than the previous 45 years. It has been an absolute fire hose of information so far. We're going to keep breaking it down for you because the next 2 hours, I think, are important. What lessons have we learned since the collapse?
And is your retirement savings, for example, protected? We've talked a lot about FDIC insurance. Where does that start and where does it stop? Also, home mortgage loans, tackling that again today in our 10 o'clock hour. And then in our 11 o'clock hour, one of our listeners said, hey, I really don't know the difference between banks and credit unions. Could I belong to 2 credit unions? We're going to get you all of that information in our 11 o'clock hour. But we're going to tee up the next 2 hours with Shane Stewart, Certified Financial Planner of DMBA. Shane, first of all, thank you for being with us every step of the way this week.
You're
as
welcome.
we ask these important questions that we, quite frankly, didn't have answers to before you stepped in studio and started walking us through this. So let's begin with this. You have been watching this coverage as closely as we have been. Break down the 3 takeaways as a certified financial planner that you're walking away this week with and how we can use those in our own homes.
Yeah. There are 3 things that I've noticed that we're really experiencing and will help you be successful. Like Dave mentioned, it's forced us to know, to learn. And that's the first thing. One is knowledge. Gain a little bit of knowledge will go a long way. And the second would be, remember we talked yesterday about your prehistoric brain, the tendency to just do anything to avoid loss, yet you might make some mistakes along the way. So understanding that, making sure we give ourselves some grace for that and say, okay, I do have a prehistoric brain. I got to be careful. And then the third thing is to be constant or consistent. So Dave, you're right. We learned so much this week, maybe that we didn't want to know, but now we know. If you arm yourself with that kind of information, however, if you pay attention, seek good sources like the 2 of you, rather than just anything off of TikTok, you then have...
I saw it on TikTok,
yeah,
Shane.
Exactly. That's my favorite line, by the way. I learned all I need to know about finances by TikTok. If you'll pay attention and learn a few things like, what is FDIC? What is NCUA? What are those coverages? Just the little things that you need to know. Yeah.
I want to dive into the prehistoric brain a little bit more because I want to know, dive into that a little bit more for people that are just joining us now. What is the prehistoric brain?
Yeah, so remember that we make, as smart as you can be and as educated as you can be, you still have a basic instinct to avoid loss. And the reason for that is because back in caveman days, your prehistoric days, if you miss out on a good meal, okay, opportunity lost. But if you get cornered by a saber-toothed tiger, you're maimed or dead. So you're really looking to avoid loss at all costs. Financial institutions, financial instruments don't work that way. They actually reward a little bit of risk, and so you do take a little bit of risk in order to get some gain. But when you hear something like a bank failed, you go, oh no, my bank's going to fail. You start thinking irrationally. it's probably not going to happen that your bank's going to fail, but that's the first place your brain goes. Your prehistoric brain tries to avoid the loss.
One of the things we learned this week is that bank failures do happen, 513 since 2009. We looked at a bank rate analysis. However, in the context of the thousands of banks that have been in business for dozens and dozens and dozens of years, that's a really small percentage. And many of those are smaller banks in cities that we'd never go to unless we had to make a pit stop on a road trip, right? Like Nebraska and Kansas and places like that. However, it still is scary when you start to hear about it. So I love your analysis of the prehistoric brain because it gets me in that mindset. Like, don't panic. It doesn't necessarily mean this is one of hundreds of dominoes that are going to fall.
That's right.
I want to dive back into knowledge. The one really important thing I learned this week is how FDIC insurance works. And that is that if you have like a husband and wife, a married couple on the same account, they're actually insured for up to $500,000.
That's right.
And then they can not that we're all running around with millions flying out of our pockets to find a bank to put in, but then in each case, they can each have a separate account, also insured up to $250,000. I never knew that, and I've asked that question before around over the years, and I really that was the knowledge, the bit of knowledge that I learned this week that I think goes a long way of feeling like more secure with FDIC insurance.
Absolutely, and not only per depositor but per institution. So, like we've talked about before, if you wanted to diversify that out a bit, you could use a couple of institutions if you wanted to. And I've mentioned this before. It's okay to have all the baskets on the same farm, meaning one institution, but make sure within that institution you're also diversified different account registrations. Yeah.
As you're talking about risk and understanding we can't be so risk averse, we have to be willing to pull the saber-toothed tiger's tail a little bit, but make sure we're like behind a big wall, something like that. Because as I was looking, for example, the history of the Dow Jones, you see this, if you take like a wide view at it, it goes up, and it goes up
always.
Yeah. But the losses, the drops, oftentimes are pretty severe. But it's for a short period of time.
Right.
And I look at it, I think if every time I saw a drop, every time I saw something happen and I sold off, that's where I would never make any money.
That's right. And you're talking about those two principles of the prehistoric brain being fearful and then not being consistent and running around trying to move your investments back and forth. And so if you combine those two things where you understand you have a prehistoric brain, give yourself a little break there, and then don't be too reactionary. You're more successful in investing. You're more successful in any financial endeavor if you don't let the fear rule.
Shane, I want to finish up with this final thought and something I've thought about for a long time, and I think it's perhaps just laziness that has kept me from making it happen is, I belong to a credit union and have for years and years, and I feel perfectly fine. Yeah. I like that space. I feel comfortable there. But I've often thought I should probably just open a bank account at a local bank, just so if anything ever did happen, and for example, if the Fed stepped in for some reason and had to shut things down, I would feel that sense of ease to know I had a second account. Maybe I don't do a lot with it. Maybe it just has a little to pay bills with, for example, to access until the FDIC insurance kicked in. And we've seen FDIC insurance kicks in. We found that out this week. Is that just making more problems for myself, more things to keep track of?
Not necessarily, as long as you don't mind two different accounts in different areas. That's actually probably a practical application of the education that you've had this week. A bad application of that would be if you said, Shane, I'm a little fearful, so I took everything out. It's under my mattress. Here's my address.
Oh, I did have that thought. I did have that thought on Sunday night.
So
but I got
would
over that.
That would actually be good application of that. Yeah, and we do have that tendency to go, let's get that money out, put it in jars, and hide it somewhere. And that would be a bad option. But your option is actually good. It's not a bad idea.
Shane Stewart, thank you for walking us through all week, because it has been a roller coaster ride. It still kind of continues to be that.
Sure.
As different banks are getting in trouble. It seems like the bank of the day. What was it, Deb? You said someone was in trouble today. But anyway, we appreciate you joining us. Shane Stewart,
Glad to. Thanks.
certified financial planner with the MBA.
First Republic Bank, all eyes on that bank in California as well. We'll see where that goes. Straight ahead, we're going to ask Derek Overstreet of the New Millennium Group, FDIC insurance or insurance at all. What covers our retirement savings or our 401k? He's calling the show live next. If you are wanting to keep an eye or an ear on our coverage as you walk into the office, just tell your boss you're live streaming us on Facebook, because that's where we are right now as well. So you're not only listening to us on the radio, you have the opportunity to hear us on Facebook at KSL News Radio's Facebook page. The next topic that we're going to dive into is a really important one for so many people who want to retire one day. Dave, me. Are your retirement savings covered by FDIC insurance?
I appreciate you bringing up that fear that I had not thought about. I have no idea. I've never thought about that. I'm just grasping the concept of FDIC insurance, like what $250,000 of insurance means. I don't know what happens with my 401k. I don't know what happens with some of these savings accounts or the retirement accounts.
Derek Overstreet, president of New Millennium Group, live on the line to help walk us through it. And I looked at the FDIC coverage this morning, and checking accounts, savings accounts, money market deposit accounts, CDs, all protected by FDIC insurance. But the big question mark here, Derek, what about our 401k or our IRA?
Well, both. Let me hit the FDIC first. You know how the FDIC limits your accounts up to $250,000?
Yeah.
If you're married, that increases to $500,000. And if you'll search around, there are banks out there that will insure your deposits up to $2 million. So just wanted the listeners to know that there are banks that will basically do what's called a sweep account, and they'll set up like 7 or 8 accounts underneath your savings or checking account to get an increased limit. And so if you call our team, we could even give you some ideas there. But
does that cost, Derek? Does it cost? Do I have to buy insurance on that amount of money?
Nope. What it is that those banks want to compete for your money. And, you know, what precipitated this call, I think, was really the failure of SVB Bank, Silicon Valley Bank. And I did a big LinkedIn article about it recently. You know, when you have one subset of the world doing banking in a certain way, and that's what it basically was all these big private equity firms would put all their money there. And then just through Twitter, you know, one big investor started pulling all their money out and couldn't get it out. And so that's kind of what scared the market. But I don't know if it bothers you guys that it's our government that keeps bailing out banks. You know, if KSL went out of business or New Millennium Group, I don't think they'd be calling us up and saying, hey, here's $50 billion, you know, go to town. Anyway, that was not the question you asked. You want to know about
401k, yeah.
Yep. The 401k, so Securities Insurance Protection Corporation only insures the cash in your accounts up to $250,000. As an example, in 2008, and this was a personal experience with me, I owned stock in Washington Mutual Bank. I don't know if you guys remember WAMU.
Yeah. Mm-hmm.
Well, basically, the federal government took WAMU, handed it to Chase Bank, and bankrupted every shareholder. So when you own stocks in your 401k, you own Microsoft or you own Apple or Tesla, the par value or the true value of that is like 0.0001, like less than 1 cent. So be very careful in your 401ks that you know exactly what your holdings are. Make sure that the companies that are inside of your 401k are well capitalized. You know, that's really what's causing this banking crisis is that they rolled back a bunch of banking regulations, you know, in the past 4 years. And I hate to tell you guys and our listeners, I think this is the tip of the iceberg. You know, there could be many more bank failures in the coming months. And that's why you've seen yesterday the markets were down heavily.
talk about IRAs and talk to me like I'm in ninth grade about this particular. Like, if I have an IRA, which I do at a bank, or it's not actually at the bank, it's like a subsidiary of the bank.
Right.
Is that protected?
Fidelity Group.
Yeah.
Only the cash. So the SIPC in a 401k and an IRA and a Roth, by the way, it's only the cash that's in there that's protected up to $250,000.
So,
and the difficulty there is that you and a spouse cannot be on the same IRA. So in that case, just make sure that if you have an IRA that has more than $250,000 of cash in it, that you divide that between 2 or 3 different institutions.
So, Derek, let me just clarify in my own brain. When you say it's just the cash, so say I've put in over the years $100,000 into my 401k. My company has matched that, let's just say for
you got 200 now.
Yeah, I got 200 in there. How much of that is but now the value is worth, say, $400,000.
Okay, so that value of $400,000, the only thing that is protected is the cash that's sitting in that account. The underlying stocks that are in it, and by the way, I think Debbie asked the question, break it down like I'm a fifth grade, really. Yeah. IRAs and 401ks and Roth, they're all the same.
Yeah.
So, the main thing I wanted to impart is that it's really just the cash portion that has that $250,000 of protection. So if you have $400,000 and it's all in the market, guess what? If there's a big market crash like there was in 2008, 1929, last year, if the companies that are in your 401 or your IRA or your Roth, if they go belly up, you get nothing. That's the scary thing. And so that's what I'm trying to say is look at your own. I know KSL, you guys have a 401k there.
Yeah.
And, every company that's listening to us, they have a 401k. Just look inside of your 401k, and if there's a whole bunch of risky stocks that you've never heard of, perhaps, talk to your advisor and say, hey, I need more dividend-paying stocks, companies that have been around, 50, 75 years and have a track record of paying dividends. But just the main thing is, the only protection you have with SIPC is the amount that's in cash. So your $400,000, Dave, if $60,000 is cash, that's the only protection you really have.
Wow. And then let's dive into the next minute or so that we have left, Derek, about dividing it up. If it's in stocks and you have more than 250 with one particular company, whether that company be Fidelity or Wells Fargo or whatever it is, do you suggest that that money be divided and put into a separate IRA with another company?
If it's I don't know that I would divide it up unless you have a previous employer. You might be able to have an IRA with one company in your 401k. What I would do to kind of keep yourself protected, there's a vehicle called an ETF or an exchange traded fund. And what that does is like you'll buy one for banks and it will cover all banks, or you'll buy an ETF for like oil and gas producers and it will have every company in there. That's truly the best way to protect yourself rather than having just, one individual stock. Now, I say that if I worked at Microsoft, and I'd probably want all of my money in Microsoft, even though some advisors advise against that. If you really know a company, I think you can safely do that. But don't worry about diversifying between many different, like Schwab and Ameritrade.
Okay.
Do more with these exchange-traded funds. They have no fees or very, very low fees, and that's the best way to go. And I think I'm somewhat familiar with KSL's. You guys are pretty safe there with the ETFs because I know that's one of their main holdings.
I appreciate you saying that. That's good news. Derek Overstreet, president of the New Millennium Group.
Yeah, we got to learn more. We'll have him back on the show in the days ahead to learn more about these ETFs. Now he's got me asking new questions, which is great. I want to know more. It's straight ahead. I'm excited to talk to Jeff Stout, Finca McGregor. He's going to rejoin the show about what's happening with mortgage rates. They have been slipping. He joined us earlier this week.
The trend has been rates coming down over the last 2-3 months. And
are they still going in that direction? He'll tell us next. Is this a potential silver lining? Say, for example, the feds decide to slow rate increases next week when they meet because of the impact we saw on SVB. So will this, in fact, mean that mortgage rates decline to the advantage of home buyers and refis? We're going to have a live conversation with Fink and McGregor's Jeff Stout in just a moment.
It's hard to always draw a line from one thing to the other. Does this affect that? I get confused because there are so many financial institutions. There are so many things we should be looking at. Banks, mortgage rates, car loans. What affects what?
I do know on Monday, in the throes of the SVB fallout, I caught that news article while we were live on the show, and it said, I think it was CNBC, reporting that mortgage rates continued to tick down just from the last week, and they ran a comparison on a $500,000 mortgage. And if somebody had locked in on that rate on Friday instead of Monday, it would have cost them an extra $128 a month on their monthly payment.
Don't hold me to this, Debbie, but I think I refinanced. The first time I refinanced, I think it was to save $100 a month. Like that was how much $100 meant to me.
Jeff Stout, owner of Fink and McGregor, back with us this morning for our special 2 hours of coverage. How are rates looking today compared to this time last week, Jeff?
Well, they are definitely lower. We talked a couple days ago, and I gave you an example of somebody that I was pricing some loans for, and this particular client is looking for a house and is actually, in fact, now under contract. But 2 weeks ago, when they were looking at another house, I priced it out just to see what their payment would be. And their pricing at that time on an FHA loan was 5.625. And Tuesday, when they were looking at another place, and when I was talking to you, I priced it again, and it went down to 5.125. And so that's, 0.5%, pretty hefty savings for them. I priced it out also yesterday and today because we haven't finalized and sent it in yet. I'm waiting on a couple things from them. But yesterday it came in at 5% even, and this morning I priced it again, and it was again at 5% even. So rates seem to have stabilized there, although we are seeing some volatility going up and down. But I mean, it's staying in that range. So that's where we are.
Jeff, can you help walk me through how much of this are we buying down interest rates? How much does it cost to buy something down? Because I think oftentimes we say, oh, you can just buy down the interest rate. Well, how much? Like, do I have to come up with $50,000 to drop it down half a percentage point? How does that work?
Well, I mean, that's a really good question. Because people throw that word out a lot, buy down, just buy it down. And, well, is it worth it? And that is the question. So the way I usually look at it with my clients is how much does it cost? How many dollars does it cost you to buy a rate down? And how much per month difference does that make? So then when you have those two numbers, then you can say, okay, this will pay for itself in 36 months. And so then the next question you have to answer is, am I going to have this loan that long? Now, people always say, well, I'm going to have this house for a long time. Yeah, maybe, but are you going to have this loan for a long time? Yeah. Because right now we're in a situation where rates are trending down, and I expect them to continue to trend down. So do you really want to pour a lot of money to lock in a rate that you may refinance out of in 6 to 12 months?
These are all great action steps as we think about the mortgage rates and the potential for the Fed to maybe not go as over the top as we had thought they would just a few days ago. I mean, we were expecting these rates to just continue to go up and up and up. kind of the exponential rate that we'd seen them going up, but now with SVB and the crash there of that bank, mainly tied to the Treasury bond and their investments in those, this makes for a very curious scenario, especially for home buyers and maybe refis. I mean, what's your rule of thumb for refinancing if somebody, for example, got in at a rate over 6%?
Well, it does depend, and so usually that's something that we look at on a case-by-case basis, because if they're at 6%, chances of that being worthwhile, it's kind of iffy, because it depends on, of course, how much lower the rate is going to be and what is the closing cost for that. So we look at kind of the same formula: how much are you going to pay for a refi, how much is it going to save you, how many months to break even.
Jeff Stout, owner of Fink and McGregor, thank you for joining us as we discuss the mortgage rates and how, at least over the last couple of weeks, they've come down nearly 0.5%.
We've got lots more to come. Big show over the next hour and 15 minutes, walking up to Maria Chaleos and all of her news that she's compiling in the newsroom right now. But I'm really excited to talk to Dave Politis again about the impact on the tech industry, because he brought so much information to us when he was in studio with us earlier this week. But in the 11 o'clock hour, we also have Boyd Matheson lined up, asking and digging into this question: are regulators at fault? What blame do they shoulder in this collapse? We also have Jeff Kaplan joining us with his analysis of the banking industry's response to this collapse. We also have more of credit unions with Scott Simpson, who's going to join us there to tell us what the difference between banks and credit unions is. But straight ahead,
if you're a marketing agency, a PR agency, and all you do is serve one industry, if that industry goes in the toilet, you're really at risk. You can go out of business fast.
Radio.
I was reminded by our producer as I was tossing to the break that the governor, let me speak to the governor, will be in-house today with Maria Chaleos. I'm hopeful that one of the questions that he's able to answer is, what was the state's plan if the federal government had not stepped in with all that FDIC insurance money and beyond, lifting the ceiling for all depositors at SVB? What was the state's plan? Governor in the House at noon today. I think the tech industry this week, Dave's learned a huge lesson. It was a crash course in what can happen if you put all your financial eggs in one bank, which is SVB.
Yeah, a tough lesson learned. I can't imagine how relieved and grateful they are that the United States government stepped in and threw a big old backstop on this and guaranteed these deposits, right? It doesn't help the investors, right? If you owned stock in SVB, then you lost every single penny and you'll never get that back. But at least if you deposited the money yourself, that's guaranteed.
We spoke to Kickstart yesterday during our 11 o'clock hour of the show. It's a Utah company that got swept up in the craziness of the collapse of SVB and was working all weekend long to come up with a plan, the what if, worst case scenario. General partner Kurt Roberts calling the show yesterday and said that they're changing the way they bank, the way they advise their clients to bank.
So we're going to be advising companies to be a bit more diversified in how they put deposits in multiple institutions, and so their entire balance doesn't become at risk on the health of any one bank.
Joining us right now is David Politis. He is the CEO of the David Politis Company. You've worked in the tech industry for more than 3 decades. Is there a biggest takeaway that when you've seen the world melt down or come close to melting down in the banking industry, what's your biggest takeaway?
Well, the biggest takeaway is not just about banking. It's for business and it's for households as well, individuals, which is if you have all of your eggs in a basket and you trip and that basket goes flying, you're at risk for all of those eggs to get broken. So you should be diversified. And every financial planner on the planet tells you that. Diversify where you keep your assets. And that may mean having some money under your mattress or hidden someplace in your house. It means probably having 2 bank accounts, at least, I would think, for most people, or 2 credit union accounts. Don't want to cause any problems there. But should you have land that you own? Yes, not everybody, but a lot of people own homes. That's a way that you diversify your assets. So I think that's probably the number one takeaway. And it's not just tech industry, it's every single industry, it's every single household. Diversify.
That is one of the biggest takeaways for me this week is how would I feel in that moment if I was the one scrambling, trying to move funds out of a bank that was on the verge of collapse. And we heard from business owners who were trying to do that last week, some who didn't even have other accounts to transfer the money to. So they're trying to manage a crisis in the middle of a crisis, and it's unmanageable.
Well, simply setting up a bank account is typically, there are some things, some neo banks, the digital-only banks where you can supposedly open an account like in minutes. But opening an account typically today, because of some of the new rules and regulations since 9/11, it's harder to open a bank account today, especially if you're opening a business account. That takes even more documentation and takes longer. So, yeah, you don't want to be running around hair on fire because you have to do something right now. You want to be thinking ahead and being smart about it. But that's definitely part of it, Deb. I appreciate that.
I do want to be careful on this criticism of Silicon Valley Bank because obviously there was a market for it. There was not enough banks. There were not enough banks lending to these startups, the tech startups.
Absolutely.
They were able to fill this niche.
Right.
You can't really blame them for finding the market, finding somebody that was underserved, providing it, and being wildly successful until Friday in 3 days when it melted down.
Yeah, $42 billion withdrawn in less than 48 hours is pretty insane. However, shame on the board of directors at Silicon Valley Bank. Shame on the CEO for going 10 months in 2022 without having a chief risk officer. A chief risk officer would have helped them to say, hey, things are changing, interest rates are being raised, and that means that the deposits we've made with treasury notes, their value, unless we hold them to maturity, is going to continue to be lower than what we've been making if we were investing now. A CRO, a chief risk officer, would have identified that, and they had smart people working there, but shame on them for not doing that. That was probably one of the biggest mistakes they made.
We also had Signature Bank collapse on Sunday in New York, which I thought, what I read, catered to real estate, but also crypto. And you brought something up just before we came back for this discussion while we were in the break, that this is massive in terms of bank failures, that they are the third largest bank failure in the United States, that all of these deposits combined between SVB and Signature add up to
over $308 billion in assets. So when Washington Mutual failed back in 2008, it was and is still the largest bank failure. But if you take the combined monies, Silicon Valley Bank and with Signature Bank, it's over $310 billion. So that's why the federal government jumped in. They're like, hey, this is domino 1, domino 2. We're going to have an entire meltdown if we're not careful. And the speed with which the federal government moved is actually laudable. Now, you can get into a whole political discussion about Democrats, Republicans, progressives, liberals, whatever, right, and conservatives about should they be doing these things? Should we let organizations fail and suffer? But I think that the answer here was federal government decided, no, this is too big. It's the ripples are not going to become ripples and become tidal waves. And so they said, we have to fix this. So it creates all sorts of other issues, the unexpected or unintended consequences. There are definitely unintended consequences of what happened over the weekend.
As you talk about these 300 billion plus of assets, now these assets haven't evaporated, right? I mean, these treasury bonds are still out there.
They're still there. That's correct.
So what does that mean?
Well, what it means is that in the case of Silicon Valley Bank and in the case of Signature Bank, A receiver will step in. Typically, that's the FDIC. They are the ones that insure your deposits up to $250,000. So they've set up new banks to take over all of the operations, all of the assets. So if you had an account with Silicon Valley Bank, as early as Monday, you could have gone in and got your money out of Silicon Valley Bank, or what it's now called DNIB. And so that's what happens. But then you still have the assets. You still have the operations. They're going to be for sale. And whether they're bought as whole, or whether they're monies that invested, create this and move it forward, that'll be what will happen over the next several weeks or months, but you'll see that move forward.
Eaten up by all the other banks?
Potentially, yeah.
They're the sharks in the water.
Yeah, there is blood in the water as well.
Are they celebrating it? I mean, this I would imagine for the other banks.
There are some that are celebrating, yes.
That's great. Great information. I mean, it's been a wild ride. David Politis, we just met you this week. This is awesome. We appreciate you taking the time.
It's been fun. I'd love to come back whenever you'd like me back on air.
Well,
You're in.
Yep. You know the way to KSL. Thank you so much. Straight ahead, Boyd Matheson making his way into studio. He's going to join the conversation of our special coverage, launching our 11 o'clock hour. He's asking this question: are regulators at fault for the bank collapses? Why wasn't it caught? Boyd Matheson joining us in studio right now to help launch us into our 11 o'clock hour, which is packed with a lot more information on this topic of our banks and our savings. Who's at fault? Are regulators to blame?
It's a great question. I was listening to a podcast from the Wall Street Journal, and this is what one of their financial reporters said, and places some blame on the regulators.
This was a bank that looked fine. It met all of the standards. It had met the capital requirements, met the liquidity requirements. Fundamentally, something went wrong there, that a bank that did, in fact, meet all of the criteria of the regulations turned out to go from a $200 and something stock Wednesday at 4 o'clock to a $0 stock Friday at 9 a.m. That shouldn't happen.
He says it met the requirements. So why did it fail? Boyd Matheson joins us right now. What do you make of that, Boyd?
Yeah, he's absolutely right. And there's been a lot of finger pointing and placing of blame of the changes that were made to the Dodd-Frank Act, which, of course, is the regulatory bill in terms of what they're supposed to be looking for, what regulators are supposed to be doing. And while everyone has pointed to changes from 2018, if you actually go and look at it, what happened in 2018, nothing changed. The only thing that was given was more discretion to the regulators on what they could do. It gave them some different thresholds they could play with, but it actually allowed the regulators, get this, to do more, not less, if they chose or if they felt it was necessary, if they felt there was risky behavior going on, if the thresholds weren't being met, all of those things could have been done, and they weren't. And so this is a regulator, and really interesting. In fact, I want to go to a quick quote that I snagged because it just tells where we really are, and it's actually from someone who's over all of the regulators. He said that, we need to have the humility and conduct a careful and thorough review of how we supervised and regulated this firm and what we should learn from the experience. That's from Michael Barr, who's the Fed's vice chair for supervision. And so everything was on the books. And as the Wall Street Journal person pointed out in your clip, Dave, they met everything, not just barely, by almost double. They met it. And so it's a really interesting thing in terms of what was it? Were the regulators just looking the other way? Were they asleep at the switch? Was there undue influence going on? We know there's always lobbyists and leveraging going on that way. So to me, there is a host of questions that everyone from Janet Yellen to Fed Chair Powell to FDIC, there's a whole lot of questions that need to be answered before we really know what went down in this situation.
You spoke to someone on your show, Inside Sources, about this, and they said something to the effect of just because there's regulations doesn't automatically guarantee stability. I want to play just about a 40-second clip from your show. Norbert J. Michel, Vice President, Director of Cato Institute Center for Monetary and Financial Alternatives.
We have to step back and recognize that all these regulations that we have, that they're providing a false sense of security. There's a limit to what they can accomplish, and there's a limit to what people can accomplish with regard to guaranteeing stability. You can have all these regulations. It doesn't mean you're going to guarantee stability. You can forecast and stress test all you want. It doesn't mean you're going to be able to figure out every single possible scenario that could go wrong and prevent it from happening. And you have to stop trying to build a system based on that.
I hear this complaint from police officers often. When we pass new laws, the question is, who's enforcing this?
Yeah.
You can pass all the laws in the world, but at some point, somebody's got to enforce it.
Yeah.
And I wonder at some point if the regulators are well-funded enough, they have enough resources to do this very thing.
Yeah, and it's so interesting because our natural reaction in any kind of big thing, whether it's a policing incident, whether it's a bank failure, our knee-jerk reaction is, well, we need more laws. The solution to this is more laws, and that's not necessarily the case. In this case, clearly, we had all the laws we needed on the books, but the people enforcing it, the regulators, weren't there. And I think this is an important point that Norbert brought up in terms of this false sense of security. Just because we pass a bunch of more laws or regulations doesn't change the game, especially when it comes to financial institutions.
Okay, so how do we make sure, Boyd, that this doesn't happen again? What's going on back in D.C. or wherever it needs to happen to make sure we don't end up with, not learning from this horrible debacle?
Yeah, so I think it begins with some transparency in terms of what did happen and how that went down. I mean, I would love to know what those regulators were looking at, because clearly they looked at this bank on a regular basis. That's the job of the regulators. And so what did they see that made them think, oh, no problem, everything's fine? Did they see indicators that were maybe suggesting things were going south?
Like maybe they had too much money tied up in treasury bonds, too many of the deposits when they reinvested it, and seeing where that was going in terms of liquidity, which they didn't have a lot of liquidity because they had these long-range safe bonds, which turned out to be a big part of the demise.
Yeah, and so some of you can say, okay, perfect storm here. Not enough focus here. Maybe looking the other way here. There's a host of things that all need to come out, and that's what the committee hearing should be about. As this starts to really get played out in front of the American people, rather than what we typically see in these hearings, or a lot of social media moments for members of Congress, we need them to ask very serious, very specific questions, and then listen and force them to answer the question. Otherwise, we'll never learn the lessons of this. And there's a whole series of things underneath that. I've been doing some conversations with some of my sources today, and I know you had the debate, and Dave's been very interested in, is this a bailout? Really interesting. As the president claimed, taxpayers are not going to pay for this. And while that may be true on the surface, the taxpayers are going to pay for this. Because what's going to happen is those FDIC funds will be used to make everybody whole in this situation. That's done by banks paying fees into that FDIC account. So now, because the FDIC is putting out all this money for these the account holders in these two banks, they're going to charge banks higher fees to put into that FDIC account. And guess where those fees are coming from? You, me, it's all of us. So the taxpayers will pay for this in a way. And here's the really interesting thing that nobody's really been talking about. The regulators did not follow the Dodd-Frank rules in how they made these account holders whole. It shouldn't have been through the FDIC. They had several other things that they should have done that were on the books. And that's what I'm watching for in the hearings with Janet Yellen today, is how she's going to explain that they did not follow the procedures in using these FDIC funds to make those account holders whole.
Boyd Matheson, thank you. A fascinating conversation. And Debbie, just my final thought, I think there is this unfair expectation on regulators, this thought that they have complete and total omniscience, that they can understand and see into the future. Listen, mortgage-backed securities were the gold standard until they weren't. Treasury bonds, the gold standard until they weren't. How could you have seen this? These were supposed to be the safest places to put your money until they weren't.
Going deep into the 11 o'clock hour, we're going to get credit union expert on the line, Scott Simpson, joining us at 11:50 to walk us through the difference between banks and credit unions and how much you're protected for your deposits at one and the other. He's going to walk us through after a listener texted us and said, I need to know more about what credit unions do, and can I be a member of two credit unions at once? Up next, Jeff Kaplan walking in studio to join us with his take on the bank run. Straight ahead in about 25 minutes, Scott Simpson. You heard him here before. He's filled in for Dave a few times. He's going to be joining us to walk us through the differences between banks and credit unions, and if you can be one person but a member of two credit unions. One of our listeners wanted to know more about that, so we are going to deliver those details to you as well. But right now, our very own Jeff Kaplan stepping in studio a few hours before he launches his show at 3 o'clock this afternoon to talk about his take on the bank run. I think we all kind of got swept up in the chaos and the confusion of it all, Dave.
I've learned so much in the last 3 days about banking in general, whether it's investment banking, commercial banking, private banking, contagion, all the words we are studying and learning about. Jeff, it's been drinking from a fire hose of information.
Yeah, we've all gone from 0 to 60 in like 5 days because what choice is there? None of us have any experience with a bank run, right?
It just sounds super scary when you hear it.
Yeah, just the words. And the only reason we know about them is because of the movie. It's a Wonderful Life. So let's make believe it's Christmas, it's raining, you're in that mob of people running toward the bank. You heard they might be going out of business.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
Yes, you've probably never seen one except in It's a Wonderful Life. People cramming into the bank and Jimmy Stewart earnestly trying to explain that a brick-and-mortar bank isn't like a piggy bank.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
When there's a run on a bank, there is no way to pay out all those withdrawals. The money's in Joe's house, or the Kennedy house, or in the case of Silicon Valley Bank, it's invested in treasury bonds. When the whispers get loud enough about a bank not having the money, the only thing that stands between the bank and bankruptcy is a guy like Jimmy Stewart or any other bank president persuading you that everything's going to be fine. In the movie, George Bailey opens his vault. He pulls out his honeymoon money, his last $2,000.
Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money.
How am I going to live until the bank opens?
I got doctor bills to pay. I need cash.
I can't keep my kids on faith. I've got to have...
How much do you need?
Hey! I got $2,000. Here's $2,000. This will tide us over to the bank reopens. All right, Tom, how much do you need?
$242.
No, Tom, just enough to tide you over until the bank reopens.
I'll take $242.
There you are.
That'll close my account.
Your account's still here. That's a loan. Okay. All right, Ed.
Well, I got $300 here, George.
All right, now, Ed, what'll it take until the bank opens? What do you need?
Well, I suppose $20?
$20. Now you're talking. Thanks, Ed. That's fine. All right.
And so it goes till midnight when they finally shut down.
2, 1, bingo! We made it! Close the door, Eustace. We made it. Look, we're still in business. We still got $2 left. Well, look, let's have some of that. Let's celebrate.
Yeah, the bank lived another day. These days, the bank run is electronic. The bank president goes on TV. George Bailey's bank survived that harrowing night, but he didn't have to deal with Twitter. See, Silicon Valley Bank was the bank of the tech industry. Of course, its customers, the kind of people who burp, and they put it on Twitter. So all of SVB's mistakes were being blabbed about on social media in real time. Everybody was reading about the problems in real time, and everybody ran to get their money. It was done inside of 2 days. Now, Dave, if that bank was catering to HVAC people or school teachers, This might not have happened so fast because they're not on social media every single second of the day, but you can't place blame on the customers for trying to get their money out. It's their money. And after a week of horrible headlines about banks, you've probably been wondering if you should demand your $242 and go elsewhere. So what do you think? The point is, it's all up to the bank president and his performance when he steps in front of the microphones because, guys, I don't know if you checked your bank accounts in the past few days and started like Googling your bank to see what you can find out. You can't find out nothing except maybe people complaining about the bank and how they screwed up on some, little tiny matter that really doesn't matter in the scheme of things. Or they might say, I hate that bank, the teller was rude, but that's the only information you can find on Reddit, on Twitter, on Insta, etc. So how do you find out? It's the bank president going in front of the cameras and one simple question. Do you trust him or not?
And we don't know him. I mean, we don't know George Bailey. Right? That may have been the case back in the 50s where you have a relationship with your banker. I don't know my bank president. There's no way I would.
That's why they have media consultants to help them through this. And they get advice like, don't say the words, quote, don't panic, because it focuses the attention on panic. Be relentlessly positive as you talk to the public.
Jeff, you have just made me think of this in a totally different light. I don't know who the Wizard of Oz is. I don't know the person behind the curtain at my bank. They change bank tellers a lot. Seems to be a new manager frequently. I mean, I don't know the people who are handling my money. And then I'll add another layer to this. When I make the deposit, I don't know how they invest my money. I don't know if it's all tied up in treasury bonds and they're not keeping an eye on the bond. They don't have a chief risk officer on hand, is what's been accused of SVB not having a chief risk officer for like 10 months in 2022.
Well, you can go to Google and you'll find news articles about it, but the news reporters have no clue because the banks don't talk about what they're doing. They don't have to. They're following the rules, but the rules are lax in this respect.
I also worry, though, that when we start doing this research, and we've seen this over the last couple of years, I've done my research, I've looked into it, and then everyone has these crazy opinions, right? Because they did 5 minutes of research. When you've got professionals that have master's degrees, PhDs, have 30 years in the business, and we think that over a weekend, we're going to educate ourselves and really learn about banking.
Well, look at SVB and Signature Bank. They didn't have a risk officer per se, but there was some guy in the boardroom who said, is this really a good idea? And everybody else said, shut up. Look at the bank we're making. Dollar, 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 make it rain. And
dollar bills.
We end up here. This is where we end up. Look, Zions Bank. Everybody who's important at that bank has stepped in front of the microphones in the past few days.
Right.
Do you trust them? They even had that Silicon Slopes event that we covered so thoroughly with the senators and the governor there speaking highly of the banking system here.
I think communication is the key to trust, right? If they're communicating, like with Zions Bank, they came on the show yesterday. I really appreciated that. Communication and just availability, and a lot of organizations now have to communicate through the media or through social media because the world is such a big place now, but that is key. I don't know if I've heard a lot from Silicon Valley Bank in the last few days.
No, they haven't been able to speak, and they're fired anyway, so it doesn't matter. But with Zions Bank, they're part of the soil here, so there's a presumption of trust.
And I appreciate that.
Right?
I appreciate that. Absolutely. Jeff, you're going to stick around, right?
Yeah.
We're going to have the Utah Bankers Association, head of the Utah Bankers Association, Howard Headley. He is calling the show in just a moment. You had a list of questions that you wanted to ask him along with our questions. So let's start asking Howard
Happy
our
to
questions.
hang out.
Let's gang up. Is that what I'm hearing?
Not at all.
We got 3 reporters all asking questions. I love it.
No. I think it's really important we get to this question with the Utah Bankers Association. How does a banking customer do any due diligence to find out where the deposits are being invested, or how well positioned the bank is to give those deposits back if you feel the need to take the money out. We're going to have that conversation in just a moment.
I think the question that pops into my head is, do I want to know or do I need to know? Does wanting to know, the curiosity that I have right now, does this actually benefit me, or am I just going to stick my toes in waters where they don't belong? When I first heard about this bank run, it took me back to senior year in high school. It was the first time I was, 17, 18 years old when I saw the movie It's a Wonderful Life.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
I had absolutely no idea what that meant. A senior in high school, I had no idea what it meant, a run on the bank. Well, I've certainly learned about it since.
Yeah, Jeff Kaplan, this is you used this movie just moments ago to walk us through kind of, that's all we all knew about a run on the bank until this week.
Jimmy Stewart was the classic bank president in that movie, and he did a masterful job of saving the bank.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
Well, that was back in the 1950s. Maybe that's what it was in the community bank.
Yeah, but it's the same argument bank presidents were making over the past week as their stocks dropped.
Joining us now is Howard Headley, the president of Utah Bank Association. Thanks for joining us, Howard.
Hey, thanks for having me. Great to be with you.
My first question for you is we were wondering if you feel a little bit like Jimmy Stewart this past week.
A little bit, yeah. I mean, I love it in terms of people being interested in our industry. I love banking. Banking plays such a huge role in our economy, our community. And most people, when things are good, nobody wants to talk to us about it. We're kind of, we're not the life of the party, so to speak. And now I think it's great. You've learned so much in the last, week. I've listened to your show. A lot of great information, and people are learning about. I think what Utah bankers, Utah is one of the largest banking states in the country, and our banks lead this country in terms of performance. And so what we sometimes regret is that the only time people really focus on banking is when there's problems, and it's through some lens of some weird bank in California. And that gets a little difficult, but I think the attention is good, and we're happy to talk about it. I've sent a ton of information over to your staff. It's all public information. We update it every quarter. People can track these things, and again, they'll see Utah is really not only one of the largest banking states, but it is the strongest banking state in the country.
There's a lot of things that I want to know about the banking industry. What do I need to know? Because I am afraid that I get just enough knowledge and just enough information to make myself dangerous.
Well, I mean, really, the main thing you need to know is that your money is safe. I mean, obviously, we've talked about the insurance up to $250,000, and ways to insure way more than $250,000. And you can, I mean, I don't have that much money, so I'm covered in one bank, and I'm all good. But you can get covered, and again, that's a floor. That's what's guaranteed. But if a bank were to fail, they're going to liquidate all the assets, the loans, and then they're going to distribute more money back to the depositors. So it's not like you're only going to get $250,000 if that's if you have more in the bank. So again, that's a floor, and really that's all you need to know. I know people talking about the Moody's report that came out, and Moody's is famous for telling us things that we already know, but they're talking to investors. They're not talking to depositors. They're talking about profitability. They're not talking about safety and soundness and stability. They're just saying, this bank might be less profitable because of this, environment. But in terms of your money in the bank, frankly, one thing you just take away from this, even in this really bizarre situation in California, basically everybody was made whole in terms of their deposits. So, that's probably all you need to know. But, I mean, I'd love for you to ask more questions.
Well, I have one, Howard. I know you find that hard to believe.
Have me on more often.
Howard Headley is the president of the Utah Bankers Association, live on the line with us. So,
yeah.
What let's say I go into a bank, or I want to form a new relationship with a new bank. How do I? Give me the first question that I should be asking about that bank or of that person who greets me at the door about that bank, Howard.
I would ask what they're doing in the community. What are they doing to help my community? What are they doing to serve my community? What initiatives they're involved in, whether it be homelessness or any kind of initiative. That you want the resources of your bank to be focused on the community where you live, if that makes sense.
Right. So, why does that matter? Why does that matter? I just want you to hold on to my money, and then when I want to take it out, I want you to give it back to me.
Dave, there's a cynical view of this. I just want to add, there's a cynical view of this where a bank will spend a lot of money sponsoring the basketball team, building houses for the homeless, and all the good things they do for the community, all for one purpose in the end, that's financial. On the day things are going south, like we saw last week, and the bank president steps up to say, trust us, you already have a pre-planted good feeling about that bank.
Howard, how do you respond to that?
Well, the whole point of banking is to take the resources that you have that you're not using right now and invest those in the companies and the community and the things around you. And the fact of the matter is, your money you're going to get your money back. So you don't have to spend a lot of time worrying about that. What you should spend your time worrying on are my resources that I have, the savings that I have, are they going to benefit the community around me? Are they being put to work while I'm not using them? To me, that is the fundamental purpose of banking, and that's what people should stay focused on. As long as there's FDIC insurance, and you really don't need to be worried about getting the money back, unless the Silicon Valley Bank thing is so unique. You've had these companies with massive deposits that way over the 250, and those companies were controlled by even a smaller handful of venture capitalists. And one morning, the venture capitalists were on the phone and said, "Hey, get your money out of the bank." It was over at that point, right? And it was just unfortunate, but there's really no other situation I can think of, and clearly no situation in Utah that's even remotely like that.
Howard Headley, president of the Utah Bankers Association, thanks so much for being on the line with us live again today. You joined us earlier in this week. We appreciate your time. Jeff, final thought.
You have to trust your bank, because there's no due diligence that you can do to find out the details. We've all tried to dig for details about how our banks are investing. We just can't find it. Google doesn't have the answers.
Jeff Kaplan, thanks for joining us. We appreciate it, and look forward to listening to you this afternoon. Thanks.
Yeah, thanks, Jeff. In a few minutes, Lindsay Aerts, we just got word from her that she's going to be jumping in with an update. The governor held a press conference this morning, as he does every month. He's also going to be in-house with Maria Chaleos for Let Me Speak to the Governor. But Lindsay says there's a development regarding the state's plan to potentially step in if these banks, these bank customers were not made whole. She's going to sort through those details live in just a moment with us. Also, Scott Simpson, he is well-versed in the credit union. He's the president of the Utah Credit Union Association. He's calling the show as well because one of our listeners said, "Hey, can I be a member of like 2 credit unions? And what's the difference between a bank and a credit union?" All great questions. We're going to dive into that with Scott live in a matter of moments. Lindsay Aerts in studio with us right now from the newsroom, where she's just learned some new details, Dave, about what the state's plan was to help backstop the situation that was happening over the weekend with SVB Bank. Had the federal government not swooped in on Monday and said, "Don't worry about it, we're going to make sure all the depositors are made whole."
Instead of watching the Oscars, this is what leaders were doing.
Right, at 10 p.m. on Saturday night. Yeah.
Trying to figure out what in the world are we going to do.
Yeah, so apparently there was this meeting between the Governor's Office of Economic Opportunity, House Speaker Brad Wilson, Senate President Stuart Adams, all the state leaders, the governor had people. I don't know if he was there specifically or at least people speaking on his behalf. But essentially, we're learning now that the state was going to backstop a potential loan program from Zions Bank in order to get tech companies who maybe needed to make payroll Monday morning some emergency cash right away, right? So this is similar to what the federal government did with the PPP loans. You remember that? Yep. So essentially, you go to a bank and you say, I need a loan, and then the federal government will make sure that the bank gets its money back, right? So this is essentially what the Governor's Office of Economic Opportunity is saying happened. And I want you to listen to this audio from Brad Bonham. He's with the Governor's Office.
In the private sector, we actually wound up working with Zions Bank. They were so gracious in offering to administer some sort of a program where we would backstop up to a certain amount that they would put together in kind of a short-term lending package for these businesses. It was all centered around payroll, though. We just didn't want people, all these different employees across the entire state not getting paid.
Linz, I'm glad that the governor's office is now speaking about this, because we asked early on in the week to have somebody there join us, because we wanted to know what the state's plan was if the federal government hadn't stepped in.
Yeah, and essentially now they're saying they would have backstopped some of these loans. Now, the governor spoke about this just moments ago on his PBS press conference, but he didn't mention the fact that the state was going to backstop some of these loans. So I need to get clarification on that. But at least one member of his office is saying that the state was prepared to help just ensure that Zions Bank got its money back.
So the question was, okay, local banks, Zions and others, is there a way that you could help these with a small bridge loan so that they could pay their employees, and then when that money comes back from the FDIC, if it takes a week or two, then you would get that money back to make you whole for those loans. So those were the types of conversations that were happening, and because those went into Sunday, and then the Sunday afternoon the announcement was made, and so we never really finished or finalized what that would have looked like.
So there you go. Those are the details about the plan. Again, I need to get clarification from the governor, who I know will be here in 5 minutes, to kind of tell me how much was the state going to backstop. Like maybe those details weren't finally finalized yet because ultimately they didn't have to implement this plan.
Yeah, it's a moot point because the federal government stepped in
right.
and took care of that. Lindsay Aerts, thank you for joining us.
Look forward to your continued coverage throughout the afternoon, Linz.
Our banks, our savings.
Do they have customers with deposits who are going to be trying to walk away?
A 2-hour special on this week's banking crisis, exclusively on KSL News Radio.
We've been talking about banks, but what about credit unions? How have they been affected? Joining us right now, Scott Simpson, president of the Utah Credit Union Association. Scott, how have credit unions been doing? Same worries, or what's going on?
Well, we've been fine. This is a different world. Credit unions are primarily made up of small depositors. A couple of distinctions. I mean, if you think about how much money was lost at Silicon Valley Bank or withdrawn last Thursday, that's almost the same amount of all of the credit union's assets in Utah put together. So we're talking about a completely different scale of trouble there. But credit unions are fine. We live in a different world. Silicon Valley Bank, I think you've been reporting somewhere around 3 to 5% of their deposits were insured, the rest uninsured. Yep. The inverse is true. Our largest credit union has 93% of its deposits under deposit insurance, and I think our average across all the credit unions is about 90%, 91%. So, just a different animal for us.
So I belonged to a credit union for a number of years, and I know they call me a member. I'm a member. Yeah. Can I be a member of two credit unions? One of our listeners wanted to know that. And I thought that is a great question. Can I be?
It is a great question, and indeed you can. There are membership eligibility requirements. You can be a member of any number of credit unions, it's your choice. You may not be able to be a member of all credit unions because you have to reach eligibility, but many, I'm a member of multiple credit unions myself.
How does FDIC and NCUA differ?
Well, the NCUA Insurance Fund has never been backfilled by the taxpayers of the United States. That's like a historical difference. We were never capitalized by the taxpayers, and we haven't been bailed out by the taxpayers in our history. From a consumer's perspective, it's essentially the same thing. It's $250,000 per depositor, and there are ways you can structure those deposits. Everything that I've heard Howard describe this last week about that, very, very much the same. The regulatory scheme around that is the same. It's capitalized and runs based on premiums paid by the credit unions themselves.
I don't know if this is possible to answer in 30 seconds, Scott, but do you think is it possible to live these days without a credit union or a bank in your life? I think about direct deposit. I think about bill pay. I think about the convenience of bill pay. What are your thoughts on that?
I think it's incredibly unwise. Where else would you go for your transactional behavior, right? If you're going to put everything on the credit account that you have for your electronic payment, peer-to-peer payment system, those are uninsured. If somebody's got a huge balance sitting on their phone system, this app that's transmitting their payments to wherever it's going, that's all uninsured. At least at a financial institution, you've got insured deposits. This crisis in California notwithstanding, I don't say this very often, but I agree with Howard that this is incredibly unique and really not relevant to retail finance in general.
Scott Simpson, thank you for joining us, president of the Utah Credit Union Association.
If you missed any of this, no worries. We will podcast this entire show on your favorite podcast platform. I'm going to be keeping an ear on KSL News Radio because Maria Chaleos is up next with the governor. It's time for Let Me Speak to the Governor.
KSL FM Midvale, KSL Salt Lake City.